Welcome to The Other Side of the Table with me, Tom Frogger. Raising money in biotech, tech bio and life sciences is crucial and complicated. In this podcast, we'll sit down with specialist investors to understand how they see the market, how they assess potential deals, and the mistakes they see time and again that you can avoid. On this episode, we're with Uzma Choudry, Biotech and TechBio investment lead at Octopus Ventures. Uzma built Octopus's TechBio desk and is an active investor and board member at several companies in the sector. If you've spent any time on the UK biotech networking scene, you may well have come across her. There aren't many people who know the space better, and Uzma's insights on how to leverage your existing investors when you pitch, why you should spend more time pursuing grant funding, and the drivers of the current market are essential for anyone who's out raising money. Stay with us for this and a whole lot more. Uzma, thank you so much for joining us. I am really excited to talk to you today about biotech, investing, pitching, fundraising, all these kinds of things. Thank you for coming on the show.
No, really excited to be on the podcast and look forward to our discussion.
Yes, absolutely. And I'm going to start off with the question that I always start with, which is about your view on the market today. And you know, being at the center of biotech, tech bio investment with Octopus, you're probably very well positioned to answer this. But of course, I got the sense things were warming up a little bit, and then we've had another war break out, and the macroeconomic situation keeps changing. We are the 2nd of November as we record this. It'll be a little later when it goes out. How do you see things right now? Where are we at from a market point of view?
Yeah, I think that, as you rightly pointed out, there is just so much happening, geopolitically. I think broadly on the macroeconomic front, I think things have evolved, significantly over the last sort of 12 to 18 months. And I think where a lot of investors were probably at the start of the year, they thought that we might hit the bottom by summer and be on our way out for recovery from this at this time of the year, so around kind of end of the year. However, I think it looks to me more like, a kind of a U rather than a sort of we kind of, straight down and back up.
Yes.
And so I think the conversations that I've had with companies that are out to fundraise, with investors, and just looking at how active these investors are currently, it seems to me that I think we're probably going to be here for at least another year. And so I don't think that this is going to change. I think we'll probably start coming out of it around sort of Q3, Q4 next year. And the positive thing is there is lots of exciting companies. There's still a lot of great research. UK is like the second biggest investor in tech bio, only behind the US. And obviously that's not a surprise given like the strength of the universities and academia in Europe. I think the second great thing is that obviously over the last year and a half, we've seen a lot of US investments made in the biospace from, US investors. So there is an increased interest from US investors in the biospace in Europe. And there's a number of investors who've now set up home in Europe. So like Catalio have now got an office here. I know that Arch have sort of now got like a full-time partner on the ground here. Orbimed's like done a press release about their sort of intentions of going deeper on bio within Europe. So I think there is a lot of evolution on that front. At earlier stage, so pre-seed, seed, there is still a significant amount of like deals happening, and there's stronger appetite there. And I think that's probably because seed, pre-seed, you're still sort of sheltered and quite far away from where I think all of it starts to trickle down. And so where it's been really difficult has been the sort of Series B plus companies and growth stage companies. The reason why this becomes particularly difficult for bio compared to software or other areas of investments is because, you know, these are typically still sort of product development, pre-revenue businesses, or, you know, businesses that are sort of got clinical pipelines, and there's still quite a lot of risk due to having very little data on whether the assets or not. And so I think that makes it particularly difficult for bio companies not to kind of then think about a bunch of companies that SPAC'd or went public, you know, during the boom, which for bio, those companies still need to tap onto equity markets for future financing, rather than, you know, for them, IPO is not an exit event, it's more of a financing event. And so that makes it really hard when you're, you know, not a revenue generating business and reliant on like releases on data, which can vary significantly. And then when you overlay that from broader, I guess if I take 1,000-foot view on more venture as an industry, as we always see, as the interest rates go up, inflation sort of hikes, investors tend to want to move away from super high risk investments into super high risk assets and more towards safer, you know, instruments like bonds. And so what we're seeing is that a lot of, you know, what I've heard is that a lot of investors and GPs, general partners and funds are actually finding it very difficult to raise their funds that they need to deploy. So there is a lot of like nervousness in the market. The great thing, however, I think about this time compared to, I think, the 2000s, or, you know, the previous biotech boom and bust, which coincided with the dot-com bubble, is that there is now a lot more capital and far more investors in this space, in the biospace versus back then. And so I think hopefully this won't necessarily be a complete like, and I don't see it that way. I don't think that this is going to be, you know, a sort of the same kind of, you know, scale and output that we'd seen in the 2000s from the previous biotech.
Well, that's good to hear.
So there's probably, I think there's probably a bit of realism. I think that from an innovation perspective and how I look at it, I think I'm super excited because this is a really great time, just looking at the maturity of a lot of like you know, technologies, including obviously our advancements in molecular tools, but also enabling tech that helps us probe a lot of the biology. So sequencing was one of them, but now we're seeing a significant more type of sensors and technologies that are able to probe other parts of biology. When you overlay that with then advancements in GPU power and compute power, you are in a really exciting time for bio. So I see this as the era of scaling biology with engineering, using engineering principles. And so there is a lot of opportunity, and for investors that have cash, I think this is a brilliant time. Because competition for deals is lower.
No, and I think you're right. I think, you know, scientifically, the amount of energy and optimism and innovation that's going on is unbelievable, right? It's just the financial situation of the world as a whole is making life a little bit more difficult. And
I think the things that will make it really difficult is, you know, like a big geopolitical event that kind of, you know, like a huge war that breaks out, that can have a huge impact and can set up behind. I think the second is something discovered and around biotech that makes it an uninvestable space. So for example, like, you know, some sort of side effects coming on the back of the COVID vaccine create issues for generations of people, that kind of thing, which I don't think, you know, the latter I don't worry about much. I think the former is probably a more real concern given the current tensions geopolitically across the world.
Absolutely. And I think with all of that in mind, in terms of the market situation, geopolitical situation, macroeconomic situation, all the things that are sort of coming together around this, for you as an individual investor, because of course everyone will take a slightly different view on this, but how does that affect how you look at potential investments and how you assess the things that are coming to you? How is it different to a couple of years ago, for example?
I think for me, a lot of that still remains the same. I'm looking for brilliant founders who have a brilliant ability to sell their vision and attract talent. Because if you're able to sell your vision, you can attract top talent, you can attract investment. So I think that's one of the key things. Is like, I still look for brilliant teams. I look for, some sort of defensible science and technology that isn't necessarily looking at incremental improvements. I'm not looking at an efficiency gain of like 2x or an optimization 3x. I'm looking at something that is, going to have fundamentally a big impact on an industry or on a sector. And so I think those two things for me are kind of like crucial: brilliant founding teams, and sort of a huge market need and a sort of pain point that drives and shifts those industries or sectors, or the way that things are done, forward in a fundamentally huge way. I think the key thing that made it really hard for me probably back in those sort of 2 years during COVID was the pricing piece. Is that you could get priced out of deals, right? And people were using pricing as a way to win deals, which was quite short-sighted, because now we're at this point where, if you optimized for a certain valuation, it's almost now a painful point for you, because you're probably going to be taking a huge discount, especially on the buyer side, because you are, you're not going to have gone between your last funding round to this funding round and, massively de-risked and generating scales. And so I think that's now become a bit more easier, because founders and founders' expectations on valuations have come back to ground floor. I think we kept ourselves quite disciplined as a team on valuations during that period. So if I look at the deals that I've done during those 2 years, they were, pricing wise, I think they were kind of done with a very like sensible lens on, rather than just trying to win a deal on the price. So certainly that's now become easier, because founders are not expecting big tags of valuation. I think that the other thing that I find that I've started focusing quite a lot on with my portfolio is strategy on, like, how do you look at your cash runway, make sure that you've got enough runway to see you through this period, if that means additional financing in the form of non-dilutive funding. So like Innovate UK is doing so many different grants to help companies. And Bio is great for that, because their intention is to help support the riskiest parts of your science and R&D within the startup. And Bio will have a lot of that, because you are doing a lot of like experimentation and R&D de-risking. So there is a lot of push on actually figuring out if there is non-dilutive sources, funding sources that we should be leveraging. We should be thinking about, if there is a potential to like extend your funding round. So okay, if there's 1 or 2 key highlight milestones that you've met, that might be a good time for you to get those investors that were excited, that may be interested in kind of writing a smaller check and coming in before the next funding round, and it gives you that slightly more breathing room. And then finally, it's actually reviewing your cash runway and business plan to understand whether we need to shift into a different gear to give us enough time, while also not compromising the growth of the company, to ride through this sort of next 12 months. And that's what I would advise other founders to do as well. I think it's also worth, I know I've heard from a lot of founders that they're trying to go back to their existing investors and asking for extensions to, but also look at non-dilutive sources of funding. Like I think I've got one company that does a really great job of finding grants, and has raised significant amount of capital just through grant funding alone.
I was going to say, it's not they're not small amounts, some of these, are they? I mean, you can raise several million through grant funding if you play it right, and I think people underestimate that sometimes.
Yeah, I think you just need to be more I just find it interesting because founders, when they're out to raise equity funding, it's the amount of effort that they put into that. And it's like, here's like some free money. And don't get me wrong, grants can come with like strings, and you can only for, and that there are, but if that is like could account for a quarter of your total funding, needs for the business, and you genuinely have parts of your R&D and technology build that could benefit from it, then I think it's worth putting in even, sort of, if not as much, even half the effort that you put into like equity fundraise, to sit down, line out all the grants that might be sort of like, applicable for the business in the next 12 months, have someone in the team dedicated to start like sifting through them and building cases around that, and start like applying for those.
Yeah, and to your previous point, that I assume would also make a company more attractive from a pricing point of view. The more non-dilutive stuff they have, the less financial risk, I suppose, there is from your point of view.
Yeah, well, I imagine for the founders, it's like, you less dilution to you. And if you can raise a quarter of your financing requirements for a funding period through non-dilutive, why wouldn't you? Like I said, some of it does come with like strings attached, and then there's like, well, you can't quite, it's not operational capital, right? So it's dedicated to specific project and workflows. So it's not necessarily like as flexible a cash option as equity funding. No, but it's still, you're doing enough R&D as a biotech TechBio company that you can have some of the projects done with grant funding versus equity funding. And
hopefully you're keeping detailed records of everything anyway, right? So putting that into an application shouldn't be
well, if you're able to sell it, if you're going out and selling like investors, and a lot of the time if you're doing biotech bio, you're probably going and pitching them to specialist investors, which mean you're preparing a lot of those material and cases. You should be doing it's an easy, like you said, it's an easy win.
Yes. So for you then, so the way that you're assessing opportunities hasn't changed that much, in that it's brilliant founders, and you said the ability to sell the vision is really the key in that. The game-changing technology that really does shift the needle is the valuation right, is the price right, and then you've talked about sort of financial management. Have they got a finger on the pulse of the finances of the business? Are they looking after the runway? Are they, have they got a plan around how to move business financially forward?
Yeah, I think the other thing that's really important, and I think what's top of mind is the self-awareness of the team. I think the best of teams almost always are ahead of everyone else on knowing, right, okay, and this is the time where I need to bring on an NED with this experience, or I need to now sort of think about a head of business development, or actually in 6 months I should then be thinking about a chief business officer. So that team evolution, someone who's aware, like, these are where my gaps are, and so I need to be able to fill them. So I think it's that self-awareness of where your limitations and where your gaps are as a management team. And then I think the second part, that's selling, your ability to sell your vision will have a huge impact on you being able to inspire people to join you. So I think that is also a key part, is you need to know where your gaps are and what the blanks are that need to be filled. That can be half the battle, because if you look at most ventures, the two things that you need is talent and capital. And so you've got to have your finger on the pulse with both of them, like having enough capital to kind of create value. I think some companies will, for example, want to raise less because they're as all of us are, super optimistic about what we can achieve
yeah,
in certain timelines, and they don't want to take on extra dilution by taking more cash. But what you absolutely do not want to do is run out of steam right before, because at that point you will probably take whatever the VC puts in front of you. And a lot of the time, I think most VCs that I know are very sensible. But if there's a deal to be done, there'll be a deal proposed which works, right, for the investors. So you just don't want to be in that position. And then, like I said, from a talent perspective, you solve for people. If you're able to hire brilliant people around you, the rest of it figures itself out.
Yeah, because there's a good chance the science is going to fail in some way, shape, or form, right? And so then it's what you do at that point, and it's the people around you that are going to determine how well you come out of that situation. Yeah.
And I think that's also why it's really important for you to, when you're thinking about your investor base, is knowing and educating those investors, because typically, if you're going for the specialist, they understand our development pushed out by a quarter or two. Oh, we've had some issues with the quality of reagents or something. Oh, stuff's pushed out for another quarter. Biotech and investors tech bio investors, to a large extent, that come from that understanding the biofield, understand that these are normal delays and these happen, and there's contingency around that. When you sell maybe to a tech investor to come into your vision and mission on a bio business, you also, when you're in that sales mode, maybe sometimes you also need to bring them on that journey of, by the way, this may mean that, this is going to take longer. We're not going to have revenues. Things may not go well in the lab, and R&D may fail, and that's not catastrophe and end be all and end all. So maybe having investors that understand the risk profile of the business that they're investing in, understand the kind of growth trajectory that the business will have, and a lot of the biospecific nuances of investment is important. And if you are bringing on generalist investors, then kind of educating them ahead so that they're not, they're able to support you as best. Because if they're expecting you to grow like a tech investment of theirs, it's not fair on you. But then if that's what they came in expecting, then it's also just creates for a really kind of sticky situation. So I would say always optimize for specialist investors that know this, and especially in biotech and life sciences. When I think more broadly for funds, I think specialist management of funds is paramount. It does make a difference to the performance of those funds. It also means that they'll have portfolios in that space. They'll have a number of companies, so they can actually support you with a lot of the common challenges that bio companies might have.
Yeah, absolutely. And so those are the things that you tend to look for in an investment. I'm sure you've seen a fair few pitches in your time, Uzma. And how regularly do those pitches actually speak to those things versus other stuff that's on the founders' minds?
So I think what I find a lot of the time, and this is probably more of a European specific lens and a bio-specific lens, is that the founders tend to concentrate a lot on science. I mean, I love that. I'm a scientist by background. I spent 5 years mucking around in a lab. Love it. But what they make up in, they have this really strong muscle. And typically when you have a really strong muscle, you'll have a cognate weak muscle if you're not training carefully. And so I would say that to ensure that while you're also, you're kind of bringing your excitement about the science and the technology, that you're also then kind of making, or you're also showing an awareness of the commercial part of this. Okay, well, how would you make money from this? How would you sell? What would you sell? Like, okay, this is these explain to me all of this amazing science, but is this a hardware? Is this a piece of software? Is this some reagents in a bottle? How would you sell this? How does this, sort of, what's the business model? What would the go-to market be? And of course, I don't expect a pre-seed seed stage company to have fully fleshed out thoughts. But what I would need to understand is, okay, here are 3 potential go-to markets. Here's the merits of each one. Here's what works best for us in our case. We don't know if this is going to gain traction, but once we get to this stage of development, we'll start engaging with stakeholders on 1 or 2 of these go-to market to understand where we get the maximum pull. For founders to be able to demonstrate that they understand the market from their customer's perspective. So, if you're selling a tool into, or your intention is to sell a tool into pharma, have you given them like a prototype of your tool, and have they given feedback and those people can speak to potentially the investors to give their view on how they think about the problem?
Yes.
And so I think all of those are important, as well as the tech piece. So sometimes if you're sort of just doing the pitch based on the science and tech, the investors will probably have lots of questions on, okay, right, this is brilliant technically, but, they don't know about the market. They don't know about go-to-market, the business model, scaling, the technology, scaling the commercials, all of that. Then you don't want them to leave with questions. So you need to show that you're commercially robust and savvy, as well as technically like brilliant. So I wouldn't expect I wouldn't expect a seed stage founder who is, a deep technical expert. I would not have expected him to have shown the ability to scale revenues at a pharma. Of course not, right? He's doing what he's doing. But I need to see some evidence that he understands how his customer base works, how this technology can be commercialized. So that is the important piece, is an ability to understand. And at some point, obviously, they will probably bring in a CBO or a chief commercial officer, or they'll bring in a non-exec in the meantime, before they sort of get to the stage where they need a full-time C-level.
Yes.
And so I think that's key. And I think the second piece that I think probably people should spend more time on is linked in with my point earlier, is the gaps. Right. That is very important. It's go in and be like, this is what we look like today, because this is what we need to achieve. Yes. We don't need a video today because we're still building the product. But this is, we're going to bring in a head of BD, because we don't need a CBO today. We need a head of BD, or maybe we don't even need a head of BD. We need an exec who has experience of selling into the industry today. And then at this next stage, we're going to need to bring in X, Y, and Z experience on board. And at Y stage, this is the kind of experience we need to bring in. That tends to fill investors with confidence, because you kind of understand, okay, this person knows what he needs. He knows where, or he or she knows where their gaps are.
Yeah, that makes sense. So it's kind of understanding, A, that there's a difference between a technology and a business, and B, how do you go from one to the other? And as you say, you're not expecting them necessarily to be right about that, just that they've given it some real thought, and what they're proposing is sensible, and they understand the mechanism of it.
And this is probably what I find in the best of like the pitches and management teams and founders that I have come across. It's been more of I've not had to like pry information out of them, and it typically comes from they typically come with a very well-formed thoughts and ideas that you can then have a conversation and a discussion on, rather than kind of, okay, have you thought about this? Have you thought about this? What do you think about that? And use your existing investors, like use your existing investors. Ask them if you can do like a run through of the pitch deck with them, and they will probably have a lot of the questions that the investors that you're going to go and pitch in front of. So make use of that. The second, and the other piece that's really important is pitch coaching. And so being in academia and presenting science at seminars and at events is very different to pitching a business. And like I said, your ability to sell your vision and your mission is key in fundraising, key in bringing on people. So your capital and talent. So I would say, even if that means that it can only improve your pitching ability by 2%, even by such a tiny amount, it is still absolutely worth it. So having a pitch coach is something that I would say that, like, even if it's a small percentage increase, given it has such a huge impact on your ability to bring on talent, raise funding, it's money well spent.
And those small percentages add up, right? So
yeah,
absolutely.
Yeah.
Uzma, that's incredibly useful. Thank you so much for taking the time with us today. I'm sure everybody listening has got a lot out of that. But best of luck closing out the year, and thank you for joining us.
No, thank you so much. It's been a really great discussion. I've really enjoyed our conversation.
Thanks for listening. Outside of hosting podcasts, I'm the CEO of a company called Singular. We work with biotech businesses from seed to Series B to help them build a brilliant culture that delivers on their milestones. Come check us out at www.singular-biotech.com, and I'll see you next episode.